There is a dream that a lot of investors carry around without ever saying it out loud. The idea that one day the dividends just pay for everything, the mortgage, the groceries, the holidays, the car payment, all of it covered by passive income arriving in your account every single month, whether you work or not. That dream is real. That outcome is achievable. But the path most people try to take to get there is where things go sideways. The most common approach is chasing individual dividend stocks. You find a company with a great yield, you buy it, and then 6 months later the yield gets cut, the share price drops, and you are back to square one, having learned a painful lesson about what a dividend trap actually feels like. Or you go the other direction and buy something like SCHD, one of the best dividend ETFs ever built, and then you look at the math and realize that at a 3.7% yield, you need approximately $3 million invested to generate $100,000 per year in dividend income. $3 million. For most investors, that is not a plan. That is a fantasy disguised as a strategy. But here is what changes the calculation entirely. Covered call ETFs. Because at the yield levels that the best covered call ETFs currently deliver, we are talking 12, 14, even 17% annually. The amount of capital you need to reach that same $100,000 income target drops dramatically. To earn $100,000 per year from SPYI at its current 12% yield, you need approximately $870,000, less than a third of what SCHD requires. That is still a serious amount of money to accumulate, but it is a number that changes what is possible for an average investor with a real-time horizon. The question then becomes, which covered call ETF is the best one to own if you are building toward that goal? Because not all covered call ETFs are equal. Some have better yields. Some have better total returns. Some are more tax efficient. Some are more diversified. The differences between the best ones and the mediocre ones are meaningful enough to matter enormously over a decade of compounding. In this video, I am running 5 of the highest quality covered call ETFs: SPYI, QQQI, TSP, TDAC, and DEVO, through a structured 6-category showdown to determine which single fund earns the title of the best one ETF portfolio to live off dividends faster. Points are awarded in each category, and the fund with the most points at the end wins. Let's get into it. Before the scoring begins, let me make sure you understand exactly what each of these 5 funds is and how they work, because the mechanism behind covered call ETF income is the foundation of everything else we are about to discuss. All 5 funds on today's list generate their distributions primarily through the same core strategy. They hold a portfolio of equities and simultaneously sell call options on those holdings. The buyers of those options pay the fund a premium, upfront cash, in exchange for the right to buy the shares at a specific price in the future. That premium income, collected continuously and distributed monthly, is what allows these funds to deliver yields that plain vanilla equity ETFs simply cannot match. The trade-off is that by selling call options, the fund agrees to cap its upside. If the market rallies strongly above the strike price of the options, the fund does not fully participate in those gains. The income is earned by exchanging some of the upside potential for reliable cash flow. Understanding that trade-off is essential for evaluating every number we are about to look at. The 5 contestants. SPYI. The NEOS S&P 500 High Income ETF, launched in August 2022 and has grown to over $6 billion in assets. It fully replicates the S&P 500 and uses actively managed index options, specifically SPX options, to generate its covered call income. QQQI, the ENEOS NASDAQ 100 High Income ETF, uses the identical ENEOS methodology applied to the NASDAQ 100, capturing the higher option premiums available from the more volatile tech-heavy index. It recently won Best New Active ETF at the 2025 ETF.com Awards, the most credible recognition in the ETF industry. TSP, TapAlpha's SPY Growth and Daily Income ETF, wraps the SPY ETF with a daily income distribution mechanism, rather than monthly, targeting investors who want maximum distribution frequency alongside S&P 500 exposure. TDAC, TapAlpha's QQQ Income and Daily Income ETF, applies the same TAP Alpha daily distribution approach to the NASDAQ 100 via the QQQI ETF rather than the full NASDAQ 100 index. And DIVO, the Amplify CWP Enhanced Dividend Income ETF, takes a genuinely different approach, holding a concentrated portfolio of 25 to 30 high-quality large-cap dividend-paying companies selected by fundamental analysis and writing selective covered calls on individual stock positions rather than index-level options. With the field set, let the showdown begin. Category 1 is diversification. The reason this matters for an income investor is straightforward. Concentration is risk. If your entire retirement income stream depends on one sector, one index, or a narrow group of companies performing well, a sustained period of underperformance in that area creates a problem that no amount of monthly distributions can fully offset. The more diversified your underlying portfolio, the lower the probability that any single sector downturn or company-specific event significantly damages your income stream. Breaking down each fund's diversification. SPYI holds every stock in the S&P 500, approximately 500 to 505 companies across all 11 GICS sectors, with meaningful exposure to technology, healthcare, financials, consumer staples, industrials, energy, and more. The S&P 500's market cap weighting does mean that the largest positions are concentrated in technology megacaps, but the breadth of underlying sector exposure is genuinely comprehensive. SPYI, being based on SPY, which tracks the S&P 500, effectively holds the same 500 company basket and inherits the same diversification profile as SPYI. Both funds give you the full breadth of the American large-cap market in a single position. QQQI holds all 100 companies in the NASDAQ 100 index. That is meaningfully fewer companies than the S&P 500, and the sector concentration is far more pronounced. Technology alone represents approximately 51 to 57% of QQQI's portfolio, and the Magnificent Seven stocks account for roughly 40%. The NASDAQ 100 deliberately excludes financial companies and has minimal exposure to energy, utilities, and materials. TDAC replicates the QQQ ETF, which tracks the same NASDAQ 100 index as QQQI, so it carries the same concentration characteristics. And DIVO holds only 25 to 30 stocks actively selected by the management team, the most concentrated portfolio of the five by a significant margin. The scoring in the diversification category is clear. SPYI and SPYI share first place as the most diversified options with 500 company S&P 500 exposure spanning the full range of economic sectors. QQQI and TDAC are meaningfully more concentrated with 100 companies and heavy technology exposure. DIVO is the most concentrated of all five. Both SPYI and SPYI earn 1 point each in this category. Running score after Category 1. SPYI, 1 point. SPYI, 1 point. QQQI, TDAC, DIVO, 0 points each. The S&P 500 funds out front early, as expected. But this race is far from over. Category 2 is dividend yield, the number that every income investor looks at first, and the most direct measure of how much cash each fund puts in your pocket relative to what you invest. For the goal of living off dividends faster, a higher yield means reaching your income target with less capital, which is the central mathematical advantage that covered call ETFs offer over traditional dividend funds. Current yields as of early 2026. SPYI distributes approximately 12% annually, one of the most consistent and well-established yield tracks in the covered call ETF space, having delivered 42 consecutive months of distributions since launch without missing a single payment. QQQI yields approximately 13.9 to 14% annually, consistently above SPYI due to the NASDAQ 100's higher inherent volatility generating larger option premiums. Higher volatility in the underlying index means options buyers pay more for the protection those options provide, which translates directly to higher premium income for the fund. SPYI yields approximately 14%, similar to QQQI, and meaningfully above SPYI, driven by TAP Alpha's income optimization approach applied to the SPY S&P 500 ETF. TDAC yields approximately 16 to 17%. The highest of the 5 funds by a significant margin, reflecting both the higher volatility premium available from Nasdaq 100 options and TAP Alpha's aggressive income extraction methodology. And Devo yields approximately 6%, the lowest of the 5 by a wide margin, reflecting the fund's deliberately conservative approach to the covered call overlay. Devo's managers write calls tactically and selectively, rather than maximizing premium income, prioritizing total return over distribution size. The winner of the dividend yield category is TDAC with its approximately 16 to 17% annual distribution rate, the highest yield on the list, and a meaningful advantage for investors trying to reach income independence with the smallest possible capital base. To put that in concrete terms, to generate $100,000 per year in distributions from TDAC at a 17% yield, you would need approximately $588,000 invested, compared to $870,000 for SPYI at 12% and $3 million for SCHD at 3.7%. TDAC earns its first point. Running score: SPYI 1, TESPI 1, TDAC 1, QQQI 0, Devo 0. Category 3 is income stability. A high yield that fluctuates dramatically from month to month is significantly less useful in practice than a slightly lower yield that arrives with predictability. When you are living off dividends, when those distributions are paying your mortgage, your utilities, your food, the consistency of that income stream is not just a nice feature. It is the entire point. A distribution that drops 40% in a bad month forces you to either draw down principal or dramatically cut expenses, which defeats the purpose of the income strategy entirely. All 5 funds on today's list have demonstrated meaningful income stability since their launches, and this is one area where the covered call ETF space has genuinely improved compared to its earlier generations. Older covered call strategies like QYLD and XYLD tied their distributions directly to the options premium collected in a given month, which meant that in low volatility environments, premiums would collapse and distributions would fall sharply. The newer generation of funds, including all 5 on today's list, use more sophisticated overlay approaches that target a specific distribution range rather than simply passing through whatever premium was available in a given month. SPYI has maintained its approximately 12% annual yield target remarkably consistently across 42 months, including the 2022 bear market and multiple volatility regime shifts. QQQI has similarly held to its 13.9 to 14% target with only modest month-to-month variation. TESPI and TDAC have maintained their respective yield ranges with the consistency that TAP Alpha's daily income approach produces. And while Devo's yield is lower, it has been extremely stable because the selective covered call overlay maintains a consistent underlying dividend income stream from its 25 to 30 high-quality holdings. Because all 5 funds have demonstrated genuinely stable distributions without the erratic month-to-month volatility that disqualifies many income ETFs, all 5 earn 1 point in the income stability category. This is the right outcome. Stability is a shared strength of this field, not a differentiator. Running score: SPYI 2, TESPI 2, QQQI 1, TDAC 2, Devo 1. Category 4 is expense ratio. Fees are the silent destroyer of long-term returns, and they compound against you in the same relentless way that returns compound for you. An extra 20 basis points in annual fees sounds trivial. On a $500,000 portfolio over 20 years at a 12% gross return, that difference compounds to roughly $200,000 in foregone wealth. Fees are boring. They are also critical. The expense ratios across our 5 funds: SPYI charges 0.68% annually. QQQI charges 0.68%. Identical to SPYI, as both are NEOS products with the same operational cost structure. TESPI charges 0.77%, slightly higher than the NEOS funds, reflecting TAP Alpha's daily distribution mechanism, which requires more operational complexity. TDAC charges 0.68%, competitive with the NEOS funds and lower than TESPI despite TAP Alpha's management. And Devo charges 0.56%, the lowest expense ratio of the five. Reflecting amplifies relatively streamlined active management approach, which does not require the complex options overlay infrastructure that the higher-yielding funds maintain. To put these numbers in context, all five are still significantly cheaper than most actively managed mutual funds, which average around 0.5 to 1.0%. But within this group, the differences are real and they compound over time. Devo wins the expense ratio category with its 0.56% fee, the lowest of the five by a meaningful margin. SPYI, QQQI, and TDAC are all tied at 0.68%. TESPI trails the group at 0.77%. Devo earns its first point. Running score: SPYI 2, TESPI 2, QQQI 1, TDAC 2, Devo 2. Category 5 is tax efficiency. Arguably the most underappreciated factor in the entire income ETF space, and the one where the differences between funds can have the most dramatic real-world impact on what you actually keep. Dividends look wonderful on a yield percentage. Dividends look somewhat less wonderful after you have paid income tax on them at ordinary rates. For investors holding these funds in taxable brokerage accounts, which is the primary setting for anyone trying to live off dividends before retirement age, the tax treatment of distributions can easily be worth several percentage points of effective yield. Here is where the structural advantage of SPYI, QQI, TESPI, and TDAC becomes most visible. All four of these funds use index options, specifically SPX options in the case of the NEOS funds and their respective index options in the case of the TAP Alpha funds, that fall under Section 1256 of the U.S. Tax Code. Section 1256 contracts receive special tax treatment. Gains are taxed on a 60-40 split regardless of how long the position is held, meaning 60% is automatically treated as long-term capital gains and only 40% as short-term. For an investor in the 22% ordinary income bracket, the effective blended tax rate on Section 1256 gains is significantly lower than the rate they would pay on ordinary income. Additionally, all four NEOS methodology and TAP Alpha funds classify meaningful portions of their distributions as return of capital, ROC, which is not taxed at all in the year it is received. ROC simply reduces your cost basis and defers the tax liability until you sell the fund. The result is that for a taxable account holder, the effective after-tax yield from these four funds is substantially higher than the headline distribution rate suggests. Devo works differently. Because Devo writes covered calls on individual stocks rather than index options, its income does not qualify for Section 1256 treatment. The option premium income is taxed as short-term capital gains or ordinary income. The qualified dividends from Devo's underlying holdings do receive qualified dividend tax treatment, but the options income, which is a significant component of Devo's total distribution, does not get the preferential rate. The practical effect is that a Devo investor in a taxable account keeps less of their stated 6% yield after taxes than an SPYI investor keeps of their stated 12% yield, making the yield gap even wider on an after-tax basis than it appears on paper. SPYI, QQQI, TESPI, and TDAC all share the tax efficiency win. All four earn 1 point. Running score: SPYI 3, TESPI 3, QQQI 2, TDAC 3, Devo 2. The sixth and final category is total return, the combination of distributions received plus share price appreciation or depreciation over the holding period. This is the most comprehensive measure of what a fund has actually done for its investors, and it is the category where the differences between income-heavy and income-light strategies become most visible, because total return is what actually grows your wealth. Distributions alone, if accompanied by steady NAV erosion, produce the illusion of income while slowly returning your own capital to you. Total return is the honest score. Measuring total return fairly across these five funds requires acknowledging an important limitation. Most of them have short track records. SPYI launched in August 2022. QQQI launched in early 2024. TESPI and TDAC are even newer. Devo has the longest history, launching in 2016. Comparing a fund with a full market cycle of data against funds that have only existed during a specific part of the cycle is inherently unfair. So let us approach this carefully. Divo's longer track record from 2016 includes both bull markets and the 2022 bear market, and its total return over that period, combining distributions with price appreciation, has been solid, outperforming several of the newer covered call funds on a total return basis from their common inception dates. SPYI, over its available history since August 2022, has achieved strong total return performance, capturing approximately 98% of S&P 500 upside during the 2023 to 2025 bull market while maintaining its 12% distribution, giving it a total return competitive with much of the plain equity market. QQQI, since its early 2024 launch, has outperformed SPYI on both yield and total return, benefiting from the Nasdaq 100's strong performance and higher option premiums. SPYI and TDAC, based on the same S&P 500 and Nasdaq 100 indices, respectively, project similar total return profiles to SPYI and QQQI once their track records extend further. Given the honest complexity of comparing funds with different inception dates across a period that includes some of the strongest equity market returns in recent history, and given that Divo, QQQI, and TDAS each make a legitimate claim to this category from different angles. Divo for its longer real-world track record, QQQI for its documented outperformance of SPYI since launch, TDAC for its Nasdaq 100 base, which has outperformed the S&P 500 over most measured periods. I am awarding this category point to Divo, QQQI, and TDAC, the three funds with the strongest total return cases. Each earns 1 point. Final scoreboard. SPYI finishes with 3 points: diversification, income stability, and tax efficiency. TSPI finishes with 3 points: diversification, income stability, and tax efficiency. QQQI finishes with 3 points: income stability, tax efficiency, and total return. Divo finishes with 3 points: income stability, expense ratio, and total return. And TDAC finishes with 4 points: income stability, dividend yield, tax efficiency, and total return. TDAC wins the showdown with 4 points, earning its position as the best one ETF portfolio to live off dividends faster based on this scoring framework. Before we close, I want to give you the honest context that any responsible breakdown of this topic requires, because the scoreboard does not capture everything, and some of the nuances matter enormously depending on your specific situation. TDAC winning this competition does not mean it is the right fund for every investor. Its 16 to 17% yield is its most compelling feature and its most significant risk simultaneously. That yield is generated from the Nasdaq 100, the most technology-concentrated major index available, through an aggressive income extraction approach. In a bull market for technology, TDAC delivers exceptional income and solid total return. In a sustained technology bear market, like 2022, when the Nasdaq 100 fell approximately 33%, TDAC's leveraged income approach would face its most serious test, and the NAV impact on a fund designed to maximize income over capital preservation could be substantial. SPYI and QQQI, the two NEOS products, carry a different risk profile. Their Section 1256 tax efficiency is genuinely superior for taxable account investors, and their track records are longer and more thoroughly tested across different market environments. SPYI's 42 consecutive months of consistent distributions, through a bear market, a recovery, and a multi-year bull run, is a meaningful credential that newer funds simply do not yet have. QQQI won the ETF.com award for Best New Active ETF in 2025, which reflects not just performance but the structural integrity and innovation of its approach. For an investor who prioritizes proven consistency over maximum yield, SPYI or QQQI may actually be the more appropriate choice, even though TDAC scored higher in our framework. Divo represents a genuinely different philosophy: fewer positions, active stock selection, tactically managed options overlay, lower yield, potentially more capital appreciation. For investors who are not yet in the distribution phase and are still accumulating, Divo's total return orientation may actually serve them better over a long accumulation period than a maximum income fund like TDAC. And for investors in tax-advantaged accounts like Roth IRAs, where the tax efficiency of Section 1256 contracts matters less, the after-tax yield comparison between these funds becomes more straightforward, and Divo's 6% yield looks less competitive versus TDAC's 17%. The most important takeaway from this entire exercise is not the winning ticker. It is the framework. If you are building toward dividend independence, the questions you need to answer are: how much income do I actually need? How much capital do I have or will I have when I reach my target? What is my tax situation? And can I hold through the kind of drawdown the underlying index of my chosen fund is capable of producing? TDXE won our structured comparison. But the best fund for your one ETF income portfolio is the fund whose risk profile, yield level, and total return characteristics are genuinely aligned with what you need from your money, not just the one that scored highest in a YouTube video. If this breakdown helped you think more clearly about your income ETF options, hit the like button and subscribe. I cover the covered call and income ETF space in depth every week with a focus on giving you the analysis that actually helps you make better decisions. Drop a comment below with your current one ETF income pick and why. I read every single one. I will see you in the next one.